Chapter 6, Variable Costing and Segment Reporting. Hello all, another chapter with good stuff in it. This chapter gives you a 2-for-1. We'll cover topics related to variable costing income statements and absorption costing income statements, as well as segment reporting. This video focuses only on variable costing income statements and absorption costing income statements. There'll be a follow-up video that deals strictly with segment reporting. The variable costing and absorption costing income statements are two different methods for presenting operating results with two different purposes. The variable costing income statement is prepared for internal users and is an excellent tool for decision makers. The absorption costing income statement is required by GAAP for external reporting. As you study this chapter, the must-know include 1. How to calculate product cost under each method. 2. How to prepare the income statement under each method. And 3. How to reconcile the difference between net operating income under each method. We've been using both income statement methods to solve problems in prior chapters, so much of what will be presented has already been seen by you. This slide includes illustrations that pretty much summarize everything that this chapter is all about. Once you complete this chapter, you need to revisit this slide and study this illustration. At that point, everything presented here should make sense. If not, then take some time to go over things again. Let's start with the cost concept review. All manufacturing companies serve two functions, the manufacturing function and the non-manufacturing function. The manufacturing processes take place in the factory building, while the non-manufacturing operations take place in an administrative building or store location. Manufacturers incur costs to produce products as well as for daily operations. We've been referring to costs of daily operations as SG&A expenses. All costs incurred to produce products take place in the factory and are related to the manufacturing process. These costs are called product costs and are attached to the product. These costs are referred to also as inventoriable, as they flow into the balance sheet as inventory and flow out to the income statement as cost of goods sold. As you know, product costs include direct materials, direct labor, and manufacturing overhead. Direct materials are the costs of those materials which can be traced directly to the product manufactured. Think of wheels or a seat for a bicycle. Direct labor includes the wages and benefits of those individuals whose work is directly related to the product manufactured. Think of the folks who are assembling the bicycle. The final component of product cost is manufacturing overhead. Like direct material and direct labor, manufacturing overhead is a necessary ingredient incurred to produce any product. But unlike direct material and direct labor, manufacturing overhead is an indirect cost, meaning that this cost, 1, cannot be traced directly to the product produced, or 2, may support multiple activities, or 3, is impractical to accurately trace to individual products. Any one of those 3 characteristics make manufacturing overhead an indirect cost. Manufacturing overhead includes indirect material like screws and glue and nails and paints. Manufacturing overhead also includes indirect labor like factory manager salary, maintenance and janitor wages. Manufacturing overhead also includes costs related to factory operations like factory utilities, factory insurance, factory property taxes, and depreciation on the factory building and the factory equipment. As you have learned, costs incurred during the production process are not initially expensed by the company. Instead, they become part of three inventory accounts which track the flow of costs during the manufacturing process from start to finish. Those three inventory accounts include raw materials, work in process, and finished goods. The raw material inventory keeps track of all direct and indirect materials bought and used in production. The work in process inventory tracks all goods being processed but not yet finished. The finished goods inventory records the cost of goods manufactured but not yet sold. As inventory, these costs are treated as current assets because they represent future benefits, as one day the finished product will be sold, generating sales revenue for the company. At the time of sale, the product cost will move from finished goods to cost of goods sold, which is an expense for the company. The cost of goods sold will then be subtracted from sales to determine the gross margin. Unlike product costs, period costs represent costs that benefit the here and now. There is no future benefit, they're one and done. Because of this, period costs are always expensed when incurred. Period costs will always show up on the income statement. These costs are referred to as SG&A expenses, and as such are associated with the cost of selling the product, the cost to support general business operations, and the cost related to company administration. SG&A expenses will include sales salaries and sales commission, marketing costs, office supplies, office salaries, executive salaries, office utilities, property taxes and insurance for the office, as well as depreciation expense for the office building and for office equipment. Having reviewed cost concepts puts us in a good position to look at the difference between absorption costing and variable costing methods for presenting the earnings of the company. It's important at this point that you understand all that has been presented. If not, please take time for some additional review.